board, midterm elections, and the case for diversification. I'm Phil Henry. I hope you know that. Greg Trzaski, Symmetry Partners. You've been doing a lot of these for 10 years.
Absolutely.
Glad to have you in Pittsburgh. Can I put you on the spot?
Absolutely.
You travel a lot. I don't want to make this too complicated, but can you just say that Pittsburgh is one of your favorite cities to visit?
I would say it's my favorite city to visit.
I didn't think it was something like that, but I'll take it.
It's my favorite, and I do travel to many cities, but Pittsburgh is my favorite, and you're my favorite person to go see that.
Very kind. Thank you. Now, what you can't see off screen, we got two big shots here. I'm waving to them right now. We got Chris Codian, Symmetry Partners, Tom Romano, VP. They get the big shots. We had lunch. We're glad you guys are here. So let's start. Now, listen. We have wars. We don't have wars. We have midterm elections. We don't have midterm elections. Those change. But what doesn't change is the case for diversification.
Right.
So let's walk these nice people through why they shouldn't be ready to jump off the cliff. And most of our clients aren't. Some of the new ones, we have to talk them off. But most people get it. If you try to jump around, you get hurt.
Yep.
But we still want to keep preaching the gospel. Even though they already understand the gospel, we still keep preaching it. The Bible says faith comes by hearing and hearing. So we like to repeat certain themes. And we'll do a little bit of that today. But let's talk about the issues at hand as well. So let's go into the market report, first of all. And we have this chart up now. So let's talk about even year to date through April. Greg, real estate, 9.2%. I thought real estate was a dog.
It's been a dog for the last several years, but this is why we diversify portfolios. This has been carrying the markets this year, and a very important part of, or a very important asset class to keep in your portfolios.
And in symmetry models, generally, if we had 100% in stocks, would about 10% be in real estate?
I think that's fair. A little less than.
Little less. Okay, so we like real estate. Now, this is commercial, primarily real estate, like we're talking about. Okay. All right, now, global U.S., these are non-U.S. companies, 8.4% year to date. But look at U.S., it's only 4.4. Hey, 4.4 in April ends up being 10% annualized. We'll take that all year long. Nothing wrong with U.S., but global's been compressed. Real estate's been compressed. Now they're popping back up because these things tend to rotate, which is why the case for diversification. And we're seeing this right now. A couple asset classes that have been pushed down are now up. The U.S. is doing fine, but not always as good. But let's look up on the right side of this chart. Large company value stocks are really doing well. Over 7% in 4 months. Growth is only 1.8. First of all, tell our nice clients a thumbnail high level. What's the difference between a value stock and a growth stock?
Yeah. Phil, so especially on the large cap side, large cap growth stocks are very concentrated in technology companies. These are companies that tend to reinvest heavily into their firms. Value companies are cheaper stocks, right? They're more fairly valued. They tend to pay a higher dividend. There's typically a reason that they're a value stock. There could be some internal, management issues, or maybe they're reformatting the company.
That's why the price is lower.
And exactly, price is lower, but they over time tend to exhibit larger growth because of that.
Example, what's a growth company or companies, value companies that people would know?
Yeah. Right now, we're seeing companies like NVIDIA and Google that are really, have been crushing it for a number of years. Those are going to fall in that large cap growth space. Now, still in technology, we look at companies like IBM or Intel. They're very large, very important to have in that industry, but they haven't been the leader. They may be playing a little bit of catch up in the AI space and the technology space.
Still well thought of, still leaders, but not on the cutting edge like some of the other companies. So we have growth, but the value stocks are doing well. They tend to do well in periods of high volatility also, which we're in right now. And then you see the same in the midterm space, 8.9 year to date versus, frankly, a little bit of a loss on the growth side. So value, and guess what? My clients know this. There was a handful of years where I was apologizing for symmetry returns. Not that you did anything wrong, but the growth in U.S. was dominating, but our portfolios had some growth, but value international It's all come back around, and now you guys are singing because all the other asset classes are doing well, international, real estate, small cap, emerging markets, while growth's still doing well.
Yep.
But the stuff that you guys have always diversified in is doing exceptionally over the last 18 months, and the portfolios are showing that.
Yep.
So patience pays off.
It definitely does.
Okay.
The portfolios have been doing real strong versus the broad market this year. And this is why we diversify. You know, your portfolios have growth in them. You just don't have as much growth as, you know, a market cap weighted portfolio might. And this is exactly why we diversify, so that we reduce those concentrations. And when volatile markets hit like what we're in, or there's a rotation from growth to value and small caps, we're able to.
We're participating. Let's look below the region snapshot, and we see emerging markets is the second line, and that includes Latin America and Asia Pacific. But look at emerging markets, 15% year to date versus, you know, US 4% again. Again, emerging markets has been compressed. Now it's probably pop back up. So we want to diversify in all these things. I talk a lot with my clients about spaghetti sauce. Why do I say that? Greg, I know you're a good chef. You're a meat guy, though. You're a grill guy.
I'm a meat guy.
Can you
but I
make
understand
spaghetti
some-
sauce?
No, I can't make it, but I get the basics of how you make it.
What do you think?
You just don't want to eat
What's the
myself.
number one ingredient in spaghetti sauce?
Tomatoes.
Tomatoes.
I've got that part down.
Okay. But to make that sauce great, and if you're in New Jersey, we're talking about gravy. But to make the sauce great, a lot of other things goes in the pot, not just tomato sauce. And a lot of things goes into our pot, not just U.S. growth stocks.
Right.
Okay. Now let's move on before we lose a lot of people. We're getting tired of my attempts at humor here. All right. Now we have factors. Let's do one more slide on investments. Okay. Symmetry is what's called a factor shop, because you take a broadly diversified portfolio, but then you slightly overweight certain areas, slightly underweight other areas based on factors. And if you look here in the middle of this chart, value, small cap, quality, momentum, minimum volatility, these are your 5 factors. Okay. And let's just look at on a year-to-date basis. Now we know, like we said, look at the top there. USA is 4.4. Okay, so that's our baseline year to date. But look at the value factor is 2 points better than that. It's 6.4. The small cap is 6 points better than that. Quality, a little bit less. Momentum, a lot more. Minimum volatility, obviously, is a dog so far this year. So if you're overweighting towards certain factors, you're going to win some and lose some. In this scenario, we've won 3 by a pretty good margin, lost a couple. We'll take those odds.
Right. And there's, you know, in markets like this, there's a pretty good reason why quality and minimum volatility are behaving the way they are. Those are the asset classes. Those are the factors that are going to kind of balance out the volatility in the portfolio, right? High quality company isn't going to fluctuate the way a higher risk company or lower profitability company is going to act. And that minimum volatility is exactly as it sounds. These are stocks that exhibit lower volatility, right? And so a market we've been in where stocks have been volatile, you expect it to be a little lower in your return, because we're trying to reduce that risk and smooth out the ride for the investor.
So for the Symmetry client, and I've believed in you guys for 24 years. My account was the first one open, and since then we have a lot with Symmetry. But you're getting a well-balanced portfolio with certain snippets that are a little bit this way, a little bit that way. But you guys are the ones in the kitchen. You guys are the ones under the hood, which is where I don't want to be. I want to be with my clients, their goals, objectives, their dreams, and have a good investment partner that's doing the heavy lifting on that side. So that's what we've done for a long time. It's worked out very well. Now, so that was a market report. What's the summary? U.S. is doing well. Other things are going even better. Growth was doing well for a long time. Now back to value. And that's the story so far. But let's talk about these other considerations now. We have geopolitical events. Let's get into that. Okay. There's a war going on. It started on February 28th. Okay. We all know what happened. U.S. Israel. We went after their top leaders. We took out 40 of them in one strike. Why? Because they are supposed to have nukes. What does Iran do? The minute we start bombing them, they start bombing their neighbors.
Yep.
What's going to happen if they have nukes on those warheads and they're bombing their neighbors? So let's not be political. That's what's going on right now. And that impacts us, certainly our world, but we want to also see how does that impact my portfolio? Okay.
Exactly.
And if ceasefires are fragile, Strait of Hormuz closed, etc. So that's all going on. How does that impact? Okay. It's too early in the game right now to look at this particular event. It's a month and a half old, 2 months old. So what you've done here is you put together a slide from 1990 to 2020, about 35 years of data of geopolitical events and what happens short term and then longer term. Would you speak to this chart to help calm people? And I think we're, in this example, better than this chart. But this is the average of an event that happened in the last 35 years. And how did markets respond? Take it away.
Yeah. And so what we typically see is in the first week after that geopolitical conflict starts, that there is some nervousness by investors in the market.
Panic selling.
Exactly. People start selling. They're scared of the markets. Volatility increases. Phil and I have preached this for years. That's why you stay diversified, and that's why you stay in the markets. But it doesn't take long to recover. We look 1 month after these conflicts start, and the average market is up 1.7%.
So let me back up a minute. The average event happens, and 5 days later, 5 trading days, the market's basically break even.
Yeah.
And then a month later, the market's up 1.7 on average. And 6 months in the middle of this conflict, it's up 6.4.
Right.
And then oftentimes the conflict is over within a year, not always. But 1 year after the start of the conflict, the average market's up 14.6%.
Yep.
Do you have the data for right now in this particular event? Where are we? We're like, what, 3 months into it now, 2.5 months?
Yeah, we're almost 3 months into it. The first week after the war started on February 28th, the market was down about 2.17, so 2.2%.
It took a 2% hit in 1 week.
1 week, right? 1 month, a little under what the average is. We were down about 2.8%. So
Still down after a month.
exactly. Now we haven't hit 6 month and 1 year on this war yet, but I can tell you how the markets have done this quarter so far. So April through middle of May here, U.S. markets are up 13.5%.
Big recovery.
Big recovery. International markets are up 13.3%.
So
they're almost identical.
Both are like up 13.
Exactly. And emerging markets that Phil mentioned before, those are up 23.6% in the last month and a half.
Okay. We have a little saying in the office: you don't have to like your portfolio, you just have to live with it. So you didn't like your portfolio that first month and a half, but you lived with it, and there's a payoff.
Absolutely. What we like to say at Symmetry, that volatility is the price you pay to capture the returns that capital markets have to offer, right? And so you have to live with these periods of uncertainty that are going to impact the markets. But at the end of the day, the stock market has historically always gone up. There's some bumps along the way, but the stock market has consistently gone up.
And really, it's the market's going to do what it does because of corporate earnings, not because of geopolitical events, not because of midterm elections. We'll do a slide on that in a minute.
Right.
Okay. So that's what's happening lately. So first week, first month, we were a little under the average. Now we're actually above the average.
Right.
Okay. So it's all good from that perspective. Now, I think we can jump now down to midterm elections. What's the impact on the market? I'm on that slide here. You know this. Every 2 years, every House of Representatives seat is up for grabs, and 1/3 of the Senate seats are up for grabs. Obviously, Republicans hold a narrow margin right now. I think the Republicans think it would be in their best interest to end this war.
I agree.
At least with 2 months before the November election. So there's a motivation there. Obviously, we got to do the right thing, but there's a motivation there to get this thing behind us, to bring oil prices down, gas prices down, so that we have that, if you will, that would, is trying to get this thing resolved as fast as possible. But get what we need: no nukes, give us the uranium, all those kind of things.
Yeah, and I think another thing that they need to look at is inflation. today or yesterday, they came out with an inflation report slightly higher than what was expected. So there's something, I guess you could argue whether it's related to the war in Iran or not, right? Oil is much more expensive than it was. But that's something that now becomes a hot topic in these midterm elections as well.
That's exactly right. So to be determined, they say like a month is like 10 years in politics, something like that. So a lot can change in the next 6 months. But that's what's happening with the midterms. Now, we want to go to key races. There's 7 or 8 states where there's key races. We don't need to dive into those. There's always key races somewhere. What are the key issues here? Obviously, you talked about inflation, cost of living being the biggest one, the war being the next one. Immigration and border security is coming down. We have a secure border. Everyone will admit that. Immigration, how are we dealing with illegal people that are in the country? There's debate still about that issue, although we're not seeing the massive riots like we were about 2 months ago.
Notice how as you're approaching that election time, the news coverage on that, and it might not just be the news that's doing it, but the reaction, how they're handling that is tending to become a little bit more balanced.
Right. So, but these are, as we go down the list here, there's always local issues. There's redistricting that popped up lately. But the top 2, obviously, inflation, cost of living, and foreign, the war itself. So those are the key midterm election issues right now. But let's take a look at this chart. And I hope people can see this chart real well. But I want you to see there's red, which means the time period that Republicans held the House and Senate. There's blue, which was when Democrats held the House and Senate. And purple is when there was a mixture. And I look at this chart, and this is from 1926 to 2024, right?
Correct.
And it's up and to the right with some bumps. Up and to the right. And that's just, again, buy it, keep it, hold it. You don't have to like it, just live with it.
This chart looks no different than any other mountain chart that we've seen. Over time, markets go up. It doesn't matter who's in office, if it's the Republicans, the Democrats, it's mixed. That's the great thing about America. It's not necessarily tied to elections and who's in office, different policies. Well, as you mentioned, it's tied to things like earnings, profitability, quality of management. All that kind of thing is what truly impacts markets. This may create some short-term noise. I think back to the first election Trump election between Trump and Hillary Clinton. She was expected to win. Markets priced in Hillary Clinton winning. And so when Trump was leading on the news that night as the votes were coming in, we saw the Dow Jones plummet over 1,000 points, right? It was a pretty significant drop. I remember my brother-in-law calling me that night. He said, should I go to cash in my 401k? I said, well, hold on, right? I mean, it's a mutual fund. It's traded the next day. This money's already gone, right? You want to recover. What was shocking is the next day we woke up and markets shot through the roof. Not only did we went from under negative 1,000 to over 1,000 points positive.
2,000 point swing.
It was one of the largest swings in the history of capital markets within, including aftermarket trading. It just goes to show that, politics will drive short-term volatility, but it's not going to drive capital markets over the long term. It's
That's right.
A little bump in the road.
Now let's take a look here. I think we have one more slide to go through just to prove this point. Let's talk about Phil Henry's career. Started in 1983, and there was 5 times in that 44-year period, 42, whatever it is, how many years? 5 times where there was like significant market events, in my opinion. The first one was in, where are we here? 87, Black Monday. The Dow Jones was trading at about 1,000 back then. Now it's 50,000. There's a mountain chart.
Right.
But the Dow went from 1,000 on October 19th to 800. It closed down 20%. People were jumping off bridges.
Right.
Within 3 months, it was back to 1,000 and then going forward.
Exactly.
But that was my first big event in the market. I was 4 years in the business, and that happened. Whoa. Then in 2000, March, the dot-com crisis, boom. All these tech companies the dot-coms is what they were called back then.
Yeah.
Most of them didn't have earnings, and they all started to crash. And that was a 3-year downturn.
Yeah.
That was a big deal in my career. And that was a real thing that happened. Hold on. If you held on, there was a big, huge bull that came on after that.
Yeah.
01, 9/11 happened. Okay, market took a hit and came right back up.
Yeah, in fact, they had to close markets for a few days.
They did.
There.
Yeah, absolutely. So that was the third one. The fourth one on here is October of 08, which was the financial crisis, the mortgage crisis, and markets took a big hit in 08, and then from 09 for the next 11 years was a huge bull market. And then COVID, 2000. If you remember, in 2000, the markets were down about 20% in one quarter. And then we ended up 15% positive for the year.
Right.
So that would be like being down 3 touchdowns in the first quarter and then winning the game by 2 touchdowns.
Yeah.
Okay. Huge turn in 1 year. All that happened. We tell people, you don't have to like your portfolio to live with it. Buckle your seatbelt sometimes. That's the best thing you do. But don't just stay in there. You'll be fine. And the other point we wanted to make too was, as we get ready to wrap it up here, we're talking about the market. We're talking about mostly stocks. But a lot of our clients are 65 years old, 70. They have portfolios that they're taking money out of. They're not 100% in stocks.
Yeah.
They're 60-40, maybe 70-30, maybe 50-50. So we're not fully exposed to all the volatility on the high side and the low side. We've compacted it by introducing bonds. We also compact it by introducing a diversified portfolio, not just in one color. In fact, we do have one final slide here. And this is a slide that I have been showing people a lot over the past year. And if you haven't seen this slide, bear with me. Everyone's been all enamored with, again, U.S. growth.
Yep.
Look at the performance, this green block for 15 years. And if you can can you highlight this? Do they see it?
It's highlighted.
Okay. The 15-year return for U.S. growth, 16.54% per year. Excuse me, even though in 2022, that asset class was down 32%. What does it mean to be down 32%? It means you start the year at $1 million and the end of the year it's 680. That's minus 32. That's painful. But if you stayed in for the whole period, you averaged 16%. Look what happened in Q1 of 25. That's when Trump held up the tariff charts. We're getting ripped off by this company, that country, this country. Markets didn't like that at first.
Yep.
Minus 11% Q1 of 25. Our clients on average, what happened to our clients in 2022? Our average client was down about 14%, not 32, because of diversification. Our average client in Q1 of 25 wasn't down 11. They were break even.
Right.
Because the U.S. growth part of our portfolio, the tomatoes were down 11, but everything else was up 11. So the portfolio's evened out. That's the value, the power of diversification that we're talking about. And oh, by the way, lest we forget the last slide, U.S. growth hasn't always been phenomenal.
Yeah.
Look at this 99 through 2009 period. U.S. growth was the worst performer, minus 0.36%.
Over 10
per year, and then it came back strong. So be diversified. Don't worry about geopolitical events. Don't worry about elections. They're going to come and go. Worry about being in the right portfolio, the right risk metric based on your age and closeness, or you're in retirement, your tolerance for risk. That's what you should worry about. Making sure you have your financial planning goals set, your retirement income plan, your tax plan. Are you looking at Roth IRAs? Are we doing estate planning? Those are the things that matter.
Yeah.
We plug you into the right portfolio and let it work for you. And you guys do a great job of building it out. You got the smart people back in Glastonbury, Connecticut. Well, a couple of them are in Pittsburgh right now. They're monitoring it. They're tweaking it. They're doing their job. Your job is to have a plan and have someone that you trust. We hope we're that people to continue to grow. And so, Greg, love having you here.
Thanks, Bill.
Thank
Be
you.
here.
There might be some questions. Kevin, are you with us backstage?
I am indeed, Phil.
He's my guy that's going to make this webinar go online in a couple of days and make us even look more handsome than we are.
Yeah, he makes us look better.
But Kevin, do you have questions for us online, Kevin?
I presently do not, Phil.
Okay, if you have a question, Phil@henrywealth.com. And thank you. And guess what? I always try to be under 30 minutes, 27 minutes. Thanks for tuning in. Replay coming. And we love you. We appreciate you. And thank you for your business and your trust.